Okay, let's unpack this. Today we are performing a deep dive into Ulta Beauty, ticker symbol ULTA. For years, this company has been, lauded as the retail category killer of the beauty world, but it is now navigating a strategic inflection point so critical. Well, it requires every experienced investor to basically tear up their old models and build a completely new investment thesis.
That's exactly right. And for the sophisticated critical investor tuning in, our mission isn't just to report on quarterly results or, simple market chatter. We need to critically analyze whether Ulta's current strategic pivot, what the company brands as Ulta Beauty Unleashed, is genuinely transforming them. I mean, are they moving from a successful domestic retailer into a high-quality, durable compounder that's capable of generating significant free cash flow for decades?
The fundamental narrative has undeniably changed. I mean, for over a decade, the story was beautifully simple. Open more stores in underserved U.S. markets, dominate that highly profitable mass-tige category, and just rely on pure square footage expansion to drive the top line. But the U.S. domestic market is maturing. It's getting saturated, and we're seeing management shift gears and shift them aggressively. They are focusing intensely now on three really complex areas: ecosystem monetization, rigorous capital allocation discipline, and ambitious calculated international expansion.
And that transition immediately introduces the single biggest, most pressing question for shareholders today. Why is the stock currently priced like a mature, low-growth conventional retailer? It's fluctuating stubbornly in that 17x to 20x forward earnings range when the underlying economic structure of the business possesses such a durable moat and, demonstrably, a clear pathway to low double-digit earnings per share growth. The market skepticism is palpable. You can see it baked right into that valuation.
Yeah, that discount is real. And I think we have to agree that skepticism centers almost entirely around execution risk, especially concerning the recent, and I mean quite aggressive, structural changes management has implemented. We're talking about a significant leadership transition, the dramatic and strategic termination of that high-profile target partnership, and, of course, the bold, unexpected international play with the Space NK acquisition.
Yeah.
These are not incremental tweaks.
Yeah.
These are radical pivots.
What's fascinating here is whether these sweeping structural changes, which, almost always cause short-term churn and confusion and elevated spending, are truly long-term value creators. Are they intended to secure the moat in a far more competitive future, or are they just near-term distractions? Distractions that pull executive focus and capital away from the crucial, intensifying U.S. competitive battle against Amazon, Sephora at Kohl's, and, well, all the direct-to-consumer brand leakage.
And we really must not overlook the significance of the leadership transition itself. The move to elevate Keisha Stillman to CEO, that signals a shift. She has been the chief operating officer known for deep operational excellence and scaling efficiency.
That is such a critical point. The previous chapter for Ulta was all about physical expansion under the prior CEO. But this next chapter, this unleashed strategy, it's about operational discipline, it's about data mastery, and it's about profitable global scale. Steelman's background in execution is precisely what the company needs to integrate these complex ERP upgrades, manage the international M&A with Space NK, and really squeeze the maximum margin out of that existing store footprint. It signals a cultural pivot away from just rapid domestic expansion and toward capital-efficient compounding. We need to dissect every one of these moves.
Let's start with the foundation of Ulta's success, the economic moat. This competitive advantage has always stemmed from their mass-tige aggregator model. It's maybe the most brilliant and defensible positioning in all of U.S. specialty retail.
It truly is the core differentiator, and it's something that's easily misunderstood. Ulta isn't just a beauty retailer, they are masters of strategic aggregation. They stock a massive catalog. We're talking over 25,000 products from roughly 600 brands. And this covers everything from budget-friendly, high-frequency mass-market staples right up through the aspirational, high-end prestige items. This high-low or mass-tige assortment is the linchpin because it lets Ulta capture the customer's entire beauty wallet in one single, often highly productive trip.
To really appreciate this, we need to compare Ulta to its primary competitors. Let's start with the prestige rival Sephora, which is, of course, owned by the luxury giant LVMH. Sephora is hyper-curated, it's focused on that luxury experience, cutting-edge trends, and high average selling prices.
Right, but that focused luxury strategy inherently creates a gap in their coverage. Sephora fundamentally misses the budget-conscious consumer who might be stocking up on necessary consumables. Think basic drugstore shampoo or face wipes or just a replacement mascara. They also miss the frequent low-cost replenishment trips for these mass-market items. So if a consumer decides to trade down because of economic pressure, whether it's inflationary or recessionary, Sephora loses that sale completely. Ulta, however, captures that sale regardless of the consumer's value decision because they stock both the prestige original and the mass alternative.
Mm-hmm.
This ability to cater to both sides of the value spectrum is a structural, non-cyclical hedge against recessionary and, frankly, just value-conscious consumer behavior.
And then if we look at the other side of the spectrum, drugstores like CVS or Walgreens or the big box retailers, they certainly compete on commodity convenience. You can pick up toothpaste and a mass market lipstick on the same trip, but they utterly lack the service component, the dedicated experiential discovery areas, and crucially, the access to new, exclusive, and highly desirable prestige brands that younger consumers are actively seeking out.
That's correct. Ulta occupies that highly profitable middle ground. It combines the accessibility and convenience of a mass market store for replenishment with the aspiration and service of a specialty prestige retailer for discovery. This hybrid model allows them to maintain margin integrity while capturing market share across the entire economic spectrum.
Okay, now let's pivot to what many sophisticated investors view as Ulta's single most critical and, I think, unrecognized asset, the data. The data generated by the ultimate rewards ecosystem. This loyalty program is so much more than a simple discount mechanism.
It's a proprietary, first-party data powerhouse, and it's operating at a massive scale that few competitors can even touch. As of the third quarter of fiscal 2025, the program boasts a record 46.3 million active members.
Wow.
Now, to put that in the critical context required by a high-level investor, that represents a huge portion of the entire adult female population in the United States. You could argue it encompasses a majority of the active beauty consumer base. The sheer density provides incredible competitive insulation and network effects.
And the revenue concentration really underscores the power of this. Loyalty members account for over 95% of Ulta's total net sales. That figure isn't just high. It tells you that Ulta doesn't have a structural customer acquisition problem in the U.S. market. Their focus is entirely on maximizing retention and deep monetization of this existing base.
And that retention is phenomenal. Among the most active tiers, Platinum and Diamond, the retention rate hovers around 95%. This high stickiness is driven by the perceived value of the points, which act like cash-off future purchases. And that's a highly attractive feature in an environment marked by persistent inflationary pressure. It ensures predictable, repeat visitation.
But the real financial leverage, the aha moment for investors, comes from how they monetize this data. Through UB Media, their burgeoning retail media network, this is so much more than basic banner ads. This is leveraging proprietary transactional data.
This is the structural hedge against retail margin compression. Brands are absolutely desperate for access to this proprietary first-party data. They want answers to questions like, which customers in this zip code bought a high-end serum and then repurchased the mass-market dupe 6 weeks later? Third-party data cookies are fading, which makes Ulta's first-party transactional data gold. Brands pay Ulta premium rates to access this audience through highly targeted ads, both on and off-site. The critical takeaway here is the margin profile. UB Media is a highly margin-accretive revenue stream. Essentially, it's 100% margin data sales, which quietly and efficiently subsidizes the inherent lower margins of the physical retail business.
So if we look at it that way, the physical store footprint, well, it generates revenue and creates experience. It's almost serving as a customer acquisition engine and a data collection point for the highly profitable, structurally superior data business. Does that mean Ulta can strategically afford to maintain slightly lower operational margins in retail compared to a pure-play competitor like Sephora because their true profitability lever is somewhere else?
That is the perfect connection to make, yes. The data business acts as a financial shock absorber. It allows Ulta to potentially compete more aggressively on price or invest more in staffing and experience costs that would crush a pure-play rival because those investments are paid for by the high-margin revenue stream from UB Media. This elevates Ulta far beyond the typical retail category.
Okay, moving on. We can't overlook the physical, service-oriented component of the moat.
Yeah.
We're talking about the full-service salons featured in, almost 1,450 Ulta stores.
The service component is strategically exponential, even if it's a relatively small part of the revenue pie, only about 4% of net sales. Firstly, they act as an essential, predictable traffic driver. A regular customer service, whether it's a hair color appointment or brow treatment, establishes a reliable 6 to 8 week visitation cadence, and that frequency is entirely independent of seasonal product launches, viral trends, or even promotional cycles. It creates structural stickiness.
And that mandatory, frequent traffic driver directly translates into a significantly higher average transaction value. Investment research clearly indicates that salon guests spend nearly 3 times as much as product-only guests when they visit the store. Why is that lift so dramatic?
It's the power of consultative selling executed in a trusted environment. When a stylist is cutting or treating a client's hair, they become an intrinsic beauty advisor. They recommend a specific color-safe shampoo, a specialized heat protectant, or a new regimen for aging skin. They are directly guiding the customer to the products on the shelves, often at the point of greatest trust. This level of physical integration, where high-touch service drives high-value product sales, is a very high barrier to entry. It's something digital competitors, most notably Amazon, simply cannot replicate, regardless of how many prestige brands they manage to onboard.
So we have the strategic high-low model, the unparalleled data asset via ultimate rewards, and the service-driven physical moat. If we translate all this operational strength into the cold language of corporate finance, what does the return on invested capital, the ROIC, tell us about the durability of this competitive advantage?
If we connect this operational narrative to the bigger picture of shareholder value creation, the numbers definitively confirm the moat's existence. Ulta's trailing 12 months ROIC is approximately 24.5% as of late 2025. Now, compare that with their estimated weighted average cost of capital, or WACC, which stands around 10.66%.
So the difference in the spread between the return they generate and the cost of the capital they employ is roughly 1,400 basis points.
Exactly. That is a massive spread. It's definitive confirmation of a very strong competitive advantage and substantial economic value added, or EVA, being created for shareholders. And while that ROIC figure is normalizing from the hyperinflated, greater than 30% peaks we saw immediately following the pandemic, which were fueled by a massive surge in discretionary spend, the current 1,400 BP spread is still absolutely top tier among specialty retailers. This confirms the company is structurally a cash-generating engine. Any investor trying to value Ulta has to anchor their model in the reality of this superior capital efficiency.
That economic firepower is absolutely necessary because the beauty industry environment Ulta operates within is, well, it's undergoing rapid and persistent change. Let's start with the big macro shift, the normalization of the famous lipstick effect.
We are witnessing a critical transition in market growth rates. The global beauty market experienced a period of really unsustainable hypergrowth, expanding at an aggressive 7% annual rate between 2022 and 2024. That pace, fueled by post-lockdown euphoria and government stimulus, was simply not structurally sustainable. The forecast is now slowing to a more moderate but still healthy 5% expansion through 2030, and it is crucial for investors to accurately characterize this shift. This is a deceleration back to historical trend lines, not an industry contraction. The market is stabilizing, but growth is now harder to come by.
And within that stabilizing market, we are seeing significant category bifurcation. Not all segments are growing equally. Where's Ulta seeing the stronger tailwinds right now?
Fragrance has emerged as the clear primary growth engine. It represents accessible luxury in a time of persistent inflation. U.S. prestige fragrance sales surged an impressive 12% in 2024. Consumers are making these calculated trade-offs. They might defer an expensive purchase like a designer handbag or a large apparel haul, but they will still treat themselves to a $100 bottle of perfume. It offers emotional satisfaction and high perceived value relative to the cost of other luxury goods. And Ulta's decision to aggressively promote fragrance is clearly paying dividends.
Conversely, the skincare category, which drove so much of that early pandemic growth, it seems to be hitting a wall.
It's definitely showing signs of saturation. It's growing only 2% in the U.S. prestige market in 2024. The consensus explanation for this slowdown is the pantry loading effect. During the initial boom years, consumers heavily invested in clinical skincare, the expensive serums, the active ingredients, and they built up large inventories. They're now just working through that stock, which means the repurchase cycle has been extended. This saturation means future growth will rely less on consumers stocking up and more on innovative new product launches or strategic expansion into adjacent markets.
Which perfectly explains why Ulta is aggressively pivoting into the broader total addressable market, specifically targeting the wellness convergence.
Precisely. The once rigid line between traditional beauty and internal health is just dissolving. We're seeing increased consumer demand for clinical-grade skincare and ingestible wellness products. And Ulta is responding aggressively to this secular trend by tripling shelf space dedicated to wellness categories in over 400 of its existing stores, bringing in marquee brands like the hair-focused supplement Nutrafol and the celebrity-backed Lemme line.
But expanding the TAM always comes with a trade-off, doesn't it? Suddenly, Ulta is competing not just with Sephora, but they are wading into the territory of specialty supplement retailers like GNC and traditional pharmacies who have long dominated that ingestible space.
That is a legitimate concern and an execution risk. Success in the clinical wellness space requires a fundamentally different level of associate education and merchandising sophistication than selling color cosmetics. Associates have to understand chemical interactions, dosing, efficacy data. That is a higher bar than traditional consultative product selling. It's a calculated, high-risk, high-reward move intended to diversify the sales mix and capture a structurally growing market.
Let's address another massive structural trend particularly powerful among millennial and Gen Z consumers, the dupe economy. The sources highlight that 75% of beauty executives cite consumer scrutiny and perceived value as a dominant theme, and the consumer trust factor is collapsing. 64% of consumers now believe premium products are not inherently higher performing than mass market options.
That trend is absolutely powered by the transparency and immediacy of social media, primarily TikTok. When a dupe video goes viral showing a $12 eyeshadow palette performing nearly identically to the $60 prestige version, it fundamentally undermines the decades-old luxury pricing model that's based on scarcity and brand mystique. If you're a pure-play luxury retailer, a dupe crisis is an existential threat. But this is exactly where Ulta's established high-low model shines as a superior structural hedge.
Because Ulta doesn't have to choose a side in that debate. They win either way.
Exactly. Take a prime example. The infamous competition between the prestige brand Tarte's Concealer and the mass alternative from ELF Cosmetics. Ulta strategically stocks both the prestige original and the highly marketed mass alternative right there on its shelves. The customer walks in seeking the product, and whether they ultimately decide on the high-cost or the low-cost option, Ulta captures the revenue. Their Q3 2025 results validated this. They reported market share gains in both the mass and prestige categories simultaneously. This means they are insulated from the value-conscious shift driven by dupe culture, making their revenue stream significantly more resilient than competitors anchored solely to high-end.
Despite this structural defense, competitive erosion is clearly evident. There are two major active threats changing the landscape in real time. First, the Sephora-Kohl's partnership.
This partnership is LVMH's direct, aggressive, neutralizing maneuver against Ulta's historical suburban real estate advantage. Historically, Ulta stores dominated the suburban off-mall strip centers, making them the most convenient destination for that high-frequency shopper. By expanding Sephora into over 1,000 Kohl's locations, often placing them adjacent to or directly across the parking lot from an existing Ulta store, LVMH effectively placed a prestige, high-touch competitor directly in Ulta's backyard. It forces Ulta to compete on customer service and experience, not just location convenience.
And the second, arguably more existential active threat, especially for the high-frequency replenishment business, is Amazon's determined premiumization efforts.
Amazon is no longer just the Wild West of third-party sellers and counterfeit goods. They are making a concerted, expensive effort to build trust and authority in the premium beauty space. We're seeing them aggressively courting high-end prestige brands. They've officially onboarded major players like Clinique and Kiehl's into their dedicated U.S. premium beauty store. More importantly, they are tightening up their gatekeeping measures, investing heavily in technology and logistics to reduce counterfeit risks.
The ultimate threat here is simple then. If Amazon successfully replicates that prestige trust factor, that feeling of security and authenticity, the sheer unmatched convenience of Prime delivery severely threatens Ulta's high-frequency replenishment business, particularly in categories like basic skincare and routine makeup, which don't necessarily require a physical discovery experience.
Exactly. And this ties directly into the third erosion factor, distribution leakage. Brand exclusivity is rapidly ending. Growth-focused brands are prioritizing reach. They're distributing through multiple overlapping channels, Ulta, Sephora, Amazon, and their own direct-to-consumer websites. And when exclusivity is gone, the retailer must compete solely on superior experience, the value of the loyalty program, and pure convenience. Ulta's moat is strong in these areas, but the competitive heat, the need to execute perfectly every single day, is at an all-time high. This makes the strategic pivots Ulta is undertaking not optional, but essential for survival.
Here's where it gets really interesting. Management recognizes the competitive reality and the market saturation challenge, and their response is not measured incremental adjustment, but radical structural pivot. The Ulta Beauty Unleashed strategy is their high-stakes attempt to future-proof the business and find new avenues for profitable growth.
These pivots are highly strategic sacrifices and bold, expensive bets. We have to start with the Target partnership termination. That was a mutual agreement announced in August 2025, concluding in 2026. This was a strategic sacrifice of easy, though minimal, top-line revenue.
The initial thesis for the partnership was compelling, right? Ulta at Target would serve as a customer acquisition funnel, exposing the Ulta brand and its prestige assortment to the younger, high-frequency Target consumer and driving incremental traffic to standalone Ulta stores. But the data showed that model was failing.
The problem was significant cannibalization, as evidenced by Plesser.ai data. Instead of acquiring genuinely new customers, the partnership was largely just diverting existing Ulta customers who were already shopping at nearby Target stores. It was pulling sales away from the higher average transaction value of the standalone Ulta locations. Furthermore, the partnership suffered from operational friction that degraded the brand experience.
Friction like inventory shrink and staff inconsistency, correct?
Absolutely. Ulta's brand equity is built on a service-oriented, premium, and knowledgeable experience. Reports indicated that the shop-in-shop suffered from elevated inventory shrink theft and lacked the dedicated, highly trained, full-service associates Ulta provides. That inconsistent staffing and experience degraded the premium value proposition. When you're trying to defend a prestige brand against Amazon, you can't afford to dilute your brand equity in a partner's aisle.
And financially, the termination is virtually a non-event in the grand scheme. The direct revenue contribution from the partnership was disclosed as well below 1% of net sales.
Which makes the exit fundamentally sound. It was a high IQ strategic decision. They prioritized control, brand equity, and redirecting traffic back to their fully owned channels where the ATV is significantly higher and they have full margin control. They sacrificed minimal revenue for maximum long-term brand health and operational control.
That leads directly to pivot 2. International expansion, executed via the Space NK acquisition in July 2025 for over $300 million, about $380 million US. This is Ulta's definitive, high-profile entry into the critical, established European beauty market.
This decision epitomizes the buy versus build capital allocation philosophy, and the source material indicates this choice was heavily influenced by the negative experience of Ulta's failed, messy, organic Canadian expansion attempt back in 2020. Why undertake the tremendous risk and expense of building infrastructure, finding real estate, and sourcing local talent from scratch when you can acquire an immediate, established, and profitable foundation?
And Space NK provides that immediate foundation.
It does. It offers 83 stores across the UK and Ireland, a mature, loyal customer base, and a sophisticated e-commerce platform that understands the European luxury consumer. And crucially, Space NK operates primarily in the premium and luxury segment. This is complementary to, but distinctly different from, Ulta's core mass-tige model. This allows Ulta to learn the high-end European consumer without risking the dilution or operational confusion of trying to transplant the U.S. mass-tige model directly into a foreign market. It's an elegant way to gain optionality.
The financial profile of Space NK must have also been highly attractive to warrant such a substantial price tag.
It's structured to be a high-growth, accretive asset. In FY 2024, Space NK reported turnover of $196.5 million. That marks a massive 34% year-over-year growth, all while demonstrating expanding EBITDA margins. Integrating a business growing at that pace significantly bolsters Ulta's consolidated growth rate and provides genuine diversification away from a saturating U.S. market.
But cross-border M&A is notorious for integration failures. We only need to look at Target's disastrous Canadian exit or many of Walmart's global missteps. What is Ulta doing to mitigate this major execution risk?
They are adopting a disciplined, hands-off approach initially. They are keeping Space NK as a standalone subsidiary under its existing successful management team. This minimizes integration disruption, which often kills retail acquisitions by trying to force systems together too fast, and it allows Ulta's core U.S. executive team to maintain focus on defending the domestic battle against Sephora and Amazon. They are using Space NK's existing leadership to be their eyes and ears, learning the market nuances before attempting any deep operational integration. It's a measured approach, not a rushed one.
Okay, finally, we turn to pivot 3, the UB marketplace. This is Ulta's structural defense mechanism against Amazon's strategic advantage of the endless aisle.
The marketplace model, powered by the established technology provider Miracle, is a masterstroke in capital efficiency. It allows Ulta to offer an array of inventory, over 100 new brands and 3,500 products, without taking on any inventory risk. The products are drop-shipped directly from the brand to the customer.
Talk us through the economic advantage of shifting this long-tail assortment to a drop-shipping model.
It is extremely margin accretive because it requires zero working capital investment for inventory or warehousing. Ulta just collects a commission on every sale. It essentially transforms a balance sheet-intensive retail operation into a technology-enabled platform business for this segment of the assortment. The commission basis is estimated to have a take rate of 15% to 18%. This generates significant revenue flow with minimal logistical costs, drastically improving their capital efficiency on products that might otherwise sit on shelves for too long.
And strategically, it serves a critical dual purpose beyond just profitability.
Yes. First, it directly competes with Amazon by offering niche, indie, and emerging brands that consumers find on social media but don't yet warrant expensive physical shelf space. It allows Ulta to capture the hype cycle immediately. Second, and perhaps more brilliantly, it functions as a low-risk testing ground. Ulta can monitor marketplace brands. If a brand demonstrates sustained traction and high volume on the marketplace, it can then be graduated to the core physical store assortment. This dramatically reduces Ulta's merchandising risk when deciding where to allocate that expensive, highly profitable shelf space. It turns the long tail into a risk-mitigated innovation pipeline.
Let's shift our attention now to the hard financials. For a company undertaking such significant strategic shifts, a CEO transition, exiting a partnership, and acquiring an international retailer, Ulta's Q3 2025 results demonstrated remarkable operational resilience. They defied most of the bearish expectations.
They delivered a high-quality beat. Net sales accelerated significantly, rising 12.9% year-over-year to $2.86 billion. That showed a distinct acceleration compared to the Q1 and Q2 performance, but for critical investors, the quality of the comparable sales beat is what really matters most.
They reported comparable sales expansion of 6.3%.
Yeah.
We need to understand what metric was the primary driver. Was it just inflation, or was it genuine consumer engagement?
It was a very healthy, desirable mix. Traffic was up a robust 2.4%, and the average ticket was up 3.8%. This is crucial evidence. It signals that Ulta is not simply relying on inflationary price increases to pad the top line, the classic low-quality retail growth. They are driving genuine physical engagement and customer visits into the store, complemented by higher spending per trip. Traffic growth in a challenging retail environment is a very high-quality metric that validates the health of the physical moat and the effectiveness of the loyalty program.
Now, we must address the most misunderstood area of the financial report, the structural margin reset. Operating margins are clearly moderating from the high peaks we saw during the pandemic.
That period where operating margins pushed toward 15% was likely an unsustainable anomaly, driven by unprecedented demand and temporarily lean staffing levels. Management has prudently guided to a new, structurally realistic range of 12.3% to 12.4% for fiscal 2025. This 12% range appears to be the new structural reality for the medium term, and investors must anchor their valuation models to this new, sustainable normal. You have to adjust expectations downward from the pandemic peak.
But the analytical key here is that this compression isn't a sign of failure. It's largely a cost transfer phenomenon driven by shrink mitigation.
That is the essential insight we have to focus on. Gross margin actually improved to 40.4%, an impressive 70 basis point expansion year over year. And what drove this? It was primarily Ulta's aggressive heavy investment in loss prevention technology and security measures, locking up high-value cases, increasing security personnel, implementing sophisticated surveillance. They successfully contained the inventory shrink and preserved gross margin.
So they fixed the theft problem, which should make the company more profitable. But if gross margin improved, why is the overall operational profitability, the operating margin, still normalizing downward?
Because those costs didn't disappear, they shifted and inflated the other major expense line item, selling, general, and administrative expenses. This led to significant SG&A deleverage. SG&A rose to 29.4% of sales, up markedly from 27.0% in the prior year. This deleverage is the direct, visible consequence of non-discretionary investments.
Which include the security staff and technology that fixed the theft problem, correct?
Exactly. Plus, you see persistent wage inflation in the specialty retail sector, forcing wages higher, massive IT investments required for the Project SO ERP system upgrade, which is a necessary modernizing investment, and the corporate overhead associated with ramping up for the Space NK international expansion. These are necessary defensive investments for a quality compounder, but they pressure near-term earnings, causing that structural margin reset to the 12% level. It's an investment year designed to secure the long-term moat.
Despite these margin pressures, Ulta's return on capital metrics remain stellar, underscoring the underlying profitability structure.
They absolutely do. With a current return on invested capital ROIC of approximately 24.5% TTM and a WACC estimated at 10.66%, that 1,400 basis point spread confirms that the company is creating substantial economic value added. It demonstrates disciplined use of shareholder capital and validates the operational excellence of the business model.
And that operational excellence is most clearly visible in the store unit economics, which are still extremely compelling, even as they approach market saturation. Ulta still plans to open approximately 63 net new stores annually.
The returns on new units are spectacular. A new Ulta store unit costs about $2.1 million to build and stock with inventory. In the first year, it generates approximately $4.1 million in sales. This translates to cash-on-cash returns that facilitate a very short payback period of just 3 to 4 years. When your new units are still generating that kind of rapid return, capital expenditure on disciplined expansion is not just warranted, it is mandatory. It remains the most profitable deployment of capital outside of the massive share buyback program.
That brings us to capital allocation. For the experienced critical investor, this is often the moment of truth. Ulta adheres to what the market affectionately calls the cannibal strategy, prioritizing the return of free cash flow through aggressive share buybacks rather than initiating a dividend.
It is a highly disciplined and critically a highly shareholder-friendly strategy, especially when the stock is trading at a depressed multiple. Ulta generates enormous free cash flow, nearly $1 billion annually, and they are committing it back to shareholders. In the first 9 months of fiscal 2025, Ulta repurchased 1.7 million shares for $693 million. This demonstrates highly proactive, consistent execution of their capital plan.
And the board provided a massive structural bid for the stock, authorizing a $3.0 billion share repurchase program in October 2024. That program represents over 10% of the company's entire market capitalization.
That signal is powerful, especially during a period of perceived uncertainty and margin resetting. This strategy creates a robust structural floor for earnings per share, regardless of short-term margin fluctuations. If Ulta retires shares at its current PE of roughly 17x, they are effectively earning an earnings yield of approximately 6% on that repurchased capital. This ensures that even if net income remains entirely flat, which is a bear case scenario, EPS will still grow at a mid-single-digit rate simply by reducing the share count. And critically, their buyback volume far exceeds the stock-based compensation, which ran at about $42.8 million TTM. This means the net share count is decisively shrinking. This is non-discretionary EPS growth.
That brings us back to the core valuation puzzle. If Ulta is a high-quality compounder with superior returns on capital and a clear structural path to low double-digit EPS growth, even guaranteed mid-single-digit growth just from buybacks, why is the market pricing it so cheaply?
The relative multiple analysis shows a significant disconnect. Ulta trades at a forward PE of approximately 17x to 20x based on the FY25 EPS guidance of around $25.35 per share.
And that 17x to 20x multiple is a major discount to its own historical valuation. Their 10-year median PE is about 31x, and the 5-year average is closer to 23x.
The market is fundamentally treating Ulta like a mature, stagnant retailer whose best growth days are definitively behind it. It's similar to the valuation assigned to legacy players in the pharmacy and convenience sector, or even distressed retailers like Sally Beauty, which trade in the 5 by 7x range. The market is ignoring the compounder optionality. It is a massive disconnect from the valuation of true hypergrowth peers like ELF Beauty, which trades at over 40x earnings. If Ulta can successfully execute the Ulta Beauty Unleashed plan and achieve even modest low double-digit EPS growth, a multiple re-rating moving from 17x to the historical 22x or 23x range is highly plausible, representing substantial capital upside.
We can confirm that skepticism isn't necessarily supported by intrinsic value analysis either. A conservative discounted cash flow analysis appears to reinforce the idea that the stock remains at least reasonably priced for a long-term holder, even if the absolute deep value window we saw when the stock traded near $300 in mid-2024 has closed.
Correct. Using conservative, disciplined assumptions, say a 10% WACC and a modest 3% terminal growth rate to reflect market maturity DCF models, peg the intrinsic value of Ulta somewhere between $433 and $700 per share. This confirms that while the stock is no longer a screaming bargain at current levels, it offers a reasonable entry point with significant upside optionality predicated on management's successful execution of these structural pivots.
Let's end with the key analyst questions. The unresolved risks that the smart money is focused on right now, the variables that will determine the future multiple. What are the 3 primary uncertainties management must address in the coming quarters?
The first is the customer acquisition funnel following the target termination. Even if the direct revenue impact was minimal, Ulta relied on Target for brand exposure, introducing the prestige category to a high-traffic, younger consumer. How will Ulta replace that brand exposure and customer acquisition pipeline? They need an alternative, scalable method to introduce their brand to genuinely new users in the US. Second, the margin structure. Can operating margins truly stabilize at 12%, given the structural pressure from persistent, non-negotiable wage inflation in the retail labor market and the increasing competitive promotional intensity, particularly with Sephora now aggressively positioned in Kohl's? Management has to demonstrate expense discipline against these structural headwinds.
And finally, the execution risk of the boldest pivot. Space NK. Will the acquisition successfully integrate and serve as a highly accretive, profitable European beachhead, allowing Ulta to learn the luxury consumer without operational missteps? Or will managing a complex cross-border M&A inevitably distract executive bandwidth and capital from the absolutely crucial domestic competitive battle against Sephora at Kohl's and the premiumization and threat from Amazon? These three variables are the fundamental determinants of whether Ulta trades at 17x or 25x earnings in the next 2 to 3 years. So, what does this all mean for you, the investor? Ulta Beauty is successfully navigating one of the most critical, high-stakes transitions in its corporate history. They are decisively shifting away from reliance on simple domestic physical store growth and toward a focus on margin stabilization, massive data monetization through UB Media, and high-quality measured international optionality via the Space NK integration.
The investment thesis, therefore, hinges entirely on the sustained durability of that proprietary Ultimate Rewards loyalty program moat and the flawless execution of the Ulta Beauty Unleashed strategic plan. The company is fundamentally a superior cash-generating machine with top-tier returns on capital, and management is returning that cash aggressively and disciplinedly through a massive share repurchase program that guarantees a floor for EPS growth.
The valuation discount implies that the market is acutely skeptical of management's ability to execute these complex, high-risk pivots simultaneously, especially the Space NK integration and the successful defense of the replenishment business against Amazon's continued premiumization efforts.
And this leads directly into our final provocative thought for you to weigh. We discussed how Ulta successfully improved its gross margin by mitigating shrink through heavy investment in loss prevention technology. The expensive locks, the security staff, the restrictive displays. We saw this cost shift directly into a higher SG&A expense, but here's the subtle kicker. Those locked cases and restrictive displays fundamentally introduce friction into the high-touch, discovery-focused shopping experience that is the core of Ulta's moat against digital competitors. The critical, unquantifiable question you need to ask yourself is, what is the true dollar cost in terms of lost customer goodwill and lost impulse sales of creating a high-friction shopping experience? And at what point does successfully reducing inventory shrink begin to cannibalize the very traffic and experiential value that differentiates Ulta from its purely transactional competitors? It is a subtle but potentially corrosive trade-off for a specialty retailer.